Welcome everybody, and I appreciate your patience. This has been the first time that we are a little late to start our session, but I assure you that we'll cover all our subject and also cover up on the time. So let's begin. Our topic for today is overseas direct investment, which is ODI. So let's first understand how do we plan to do it. We plan to cover up on why it is important for us practicing professionals and people in India to know about ODI and to know about what we are allowed to do. To what extent are we allowed to do it? What are the concepts specifically mentioned under the ODI regulations? At the same time, it is very, very important to understand what are the key restrictions, what we are not allowed to do. Because under FEMA, the moment we do something which we are not allowed to do, there is a lot of repercussions and penalties that dwell upon us. And hence, that's going to be our objective and the journey for today. We're going to be taking a session till 5:50. That is another 40 minutes. We're going to be dealing in the concept of ODI and understanding what it is. And last 10 minutes, I'll put it up for Q&A, wherein I'm open to answering all your questions. Feel free to post your questions in the chat box. We'll be taking it up during the sessions and post sessions too. Oh, cool. Okay, so now, first of all, let's understand why ODI. So ODI is investing outside India. As an Indian, if I or my company wants to do businesses outside India, then ODI is attracted by many destinations. Like today, if we would see the data and analysis for the data of April to December last year, what we could see was Singapore was the top country which attracted more and more Indian businesses. Approximately 20 to 21% was by Singapore. The alarming country which grew over the time and have taken up much more share in the past 1 or 2 years has been Netherlands. Yes, guys, Netherlands is the upcoming destination for doing businesses outside India. And the other known, much favorite has been UAE, USA, and UK. Mauritius, which at one point of time was considered to be one of the favorite destinations, is now taking a back seat. As we know which countries are more favorite, we also need to understand which sectors are the ones which attract, are the ones, which are going outside India to do businesses. So 40% of the entire analysis that we did, we realized 40% of the business sector that was from the manufacturing domain, and was from the financial domain. And the second biggest sector was wholesale and said as trading, retail, restaurants, and manufacturing. Both of this put together contributed more into the financial front, and I believe that is also a reason we are seeing a good spur in Singapore, because Singapore, in a way, also being a financial capital and more of financial sector, people going abroad to do businesses. Having understood what has been the growth and what has been the change in the destinations over the time, how I said as new Netherlands coming into the picture, we also needed to understand कौन सी country में क्या चीज ज्यादा जाती है. We are taking this basic understanding so that we as professionals understand how important it is for us to know a few basic laws around FEMA, because now it's not only those huge giants go outside India to do businesses, but a lot of individuals who may be into software or providing their tech services or providing their skill-based services are also opening up companies in US and UK. So here is a quick brief summary of which country attracted more sectors. This is something which I would really like to highlight and take up, but in detail more later. I'm just showing a trailer over of this part. How many of you would have been using Instagram and YouTube Reels for your entertainment? Give me thumbs up to know that yes, we've been using Instagram and Reels. Instagram Reels or YouTube Reels is what we have regularly been watching. Yeah, I know I should have been flooded with the thumbs up. And yes, that is in your Instagram Reel ka feeds or on your YouTube feeds or Facebook or whatever other social media channel that you've been using, is that there is property available in Dubai, and please buy those property. And there are easy ways to buying the property, and you can make huge money by investing in Dubai. How many of you have come across this ads in your Instagram feed? Yes. Guys, yes, a lot of them. I can see a couple of thumbs up coming out here. Yes, guys. In fact, if you are a regular user, you would see that every 10, 12 ads, you will find an ad saying buy property in Dubai, easily pre-leased, easily can be given on lease. And there are loads of Indian companies and individuals who have already bought companies and bought properties in Dubai, especially from the getting lured to the fact that property prices भी बढ़ेंगे और lease rentals आपको खाने को मिलेगा. So with an intention of earning lease rentals, we are seeing this coming up. There is a big alarm and a signal that should go up the moment you talk about buying a property in Dubai or any part of the world and giving it on lease or doing this from a leasing perspective. So we'll be touching in detail on this part a little later, but a very important point to be noted here, because a lot of people have goofed up here and are today under the scanner and taking the heat of RBI questions and RBI penalties too. So we understood why it is important. Now let's see, if we want to study ODI, what are those basic principles or basic rules, regulations that we need to look upon. So for ODI, we need to look upon the master direction. Second, we need to look upon the overseas investment rules and the regulations. Once you've gone through and referred these three basic provisions, you would have got yourself covered on the RBI laws of ODI, but make sure you also refer to the FAQ and a couple of case studies, because interpretation of SEMA at times can be a little tricky. So now that we are set and all of us have clients who may want to go abroad, let us understand who are eligible to do businesses outside India. So the first of all, there are two categories of people who are permitted. One is resident individuals. Yes, people like us can also open companies outside India. There are separate provisions, separate restrictions, separate limitations by which we can open up our own companies outside India and do business. And at the same time, any Indian entity, which can be a Indian private limited or a public limited company, registered partnership firms or an LLP, are the ones who are allowed to set up businesses outside India and are allowed to do ODI. So to begin with, we'll start off first with the Indian entity and understand that Indian entity, under the provisions of Indian entity, who all are allowed to do businesses outside India. As I said, that it's Indian company, or it can be a registered partnership firm or LLP. But the question would be, to what an extent? How much money can I invest outside India? So the provision says that you can invest up to 400% of your net worth. आपकी औकात से 400 गुना ज्यादा you can go out and invest. And this calculation is given under the term of financial commitment, which has been defined by the law. What we need to do is calculate the net worth of our client. Say, for example, our net worth of our client is 10 lakhs. Then he is allowed to invest up to 40 lakhs outside India. What instruments, that will touch upon, but to what extent, it is 400%. Now, this investment can be in form of equity, it can be in form of a debt, or it can be in form of a non-fund based instrument, which is like guarantee or pledge or a charge. And the way you calculate the limit of 400% is also mentioned. So equity will be fully calculated. You will have, if you are having your performance guarantee, then 50% of that will be calculated when you arrive at the value of coming up to 400% of the calculation. Now I have few questions coming in the chat box, but what I want to understand is that question is relating to compliance and resident individuals. So Siddharth, I will be covering up both your questions in due course. If by the end of the session you do not get an answer to your question, feel free to post it again and I'll take it up again. So we move to the next part. As we said that yes, you're allowed to invest outside India up to 400%. You can invest in terms of uh, debt or equity, or it can be a non-fund based facility, which is a guarantee. But you need to also make sure, the key point here would be that if you want to give out loan, the first thing that you need to acquire is equity. Unless you have acquired equity into the company, you cannot give loan to that company. Secondly, once you also need to make sure that you can acquire an existing business also, or you may choose to set up your own business, which means you can invest or subscribe to the memorandum of the company, the new business, or you can also acquire an existing company. So this is up to on what you can do. The another aspect of which comes up is what are the restrictions, what are the sectors under which we are permitted to do this activity. So here the provisions are very liberal. It says that most of the activities you are allowed to do outside India. If you are under financial service sector, there are specific restrictions saying that you yourself should be into financial service sector in India. ट्रैक रिकॉर्ड होना चाहिए, बिकॉज किसी को भी हम लिबर्टी नहीं देना चाहते ना कि भाई कोई भी मुंह उठा के वहां पे धंधा चालू कर दे. So no, if you have track record and expertise to do financial service business, then yes, you can go abroad and do that as well. But beyond that, rest all the businesses, the permission is given, provided the wordings used here is the business should be a bona fide business, a bona fide and a legitimate business, then yes, you are permitted to do it. But there is a specific restriction which has been given, which is real estate activity. Now here the definition is very clear, saying that you cannot do any real estate trading activity. So the law says that अगर आप वहां पे जाके construction and development कर रहे हो, then there is no problem. But if you intend to do trading of the activity, and also if you intend to do leasing of the business, you are going to be into leasing business, then no, you are not permitted to do it. Similarly, hence all those ads that we've been getting from Dubai, they may be valid from the Dubai law perspective, but from India law perspective, they are not allowed as per India FEMA. You can acquire land under the immovable property regulations. The Indian resident individual is allowed to acquire land outside India, immobile property outside India. He can use it for his own consumption. But if you want to start a leasing business, then it is not permitted. It will be considered under real estate activity, and hence very important that we are aware of this provision and we make our clients also aware of it, because there is a lot of ads and reach done by the Dubai government or the companies who are into this for getting investments from India. But currently these are not allowed from the India law perspective, especially leasing. Acquisition is still permitted, leasing is not permitted. Now we said that okay, Indian entity can go abroad, start business under any sector. They can not only start business under any sector, but they can give equity, they can give loan, they can give performance guarantees or any other kinds of bank guarantees up to 400% of the net worth. And only restriction was in terms of the business has to be a legitimate and a bona fide business. Now let's see what are the repercussions or what are the restrictions or allowances for a resident individual. If a resident individual wants to just go ahead outside India and invest into some business, then it will be called as OPI. And if you want to go outside India and start your own business, it is considered as LRS ODI. In both of these scenarios, as an individual, it is not linked to your net worth, but it is linked to you are given a blanket limit of 2,50,000 USD per financial year. Now it is your choice. You can use this 250, 100 to lakh 50,000 US dollars either for your travel, as donations, or your own son's gift, employment, whatever, or you may also use it for your business. But this is the limit which has been given to every resident individual to invest outside India. Same, you can invest outside India, but now since you are going as an individual, all you can give outside India is equity. You cannot give loans. You have to give equity only and set up your business outside India, which has to be a legitimate business only. So now let's have a quick comparison. If we go in for an overseas direct investment by an Indian company, then it's going to be up to 400% of your net worth. But now, what is overseas portfolio investment? Suppose I chose that, uh, uh, this now here we are talking about the Indian entity. We said individuals, yes, allowed up to the limit of 2,50,000 USD. Now the question comes, what about Indian entity? Can Indian entity invest outside India? We said yes. Now the question comes, can Indian entity invest outside India in any listed space? Can they acquire shares of any listed entity? Then that is considered under overseas portfolio investment. And there are limits to which they are allowed to invest outside India based on their net worth, and which is calculated out of their last audited balance sheet. If they ever think of investing more, like for example, you want to invest more than 1 billion US dollars, then yes, you have to take prior approval of RBI for the same. And other than that, for all the activities, you have general permission to carry out businesses. Now the question would be, what all can be my medium of investment? So first of all, for investing in outside India, what mediums will be required is, one, individual can be either you can acquire directly shares, you can acquire rights or bonus shares, you can also capitalize whatever is due to you. There can be mergers, demergers for which you may get shares. There can be ESOPs for which you can get it. But there are conditions which are applicable to individual and a few conditions which are applicable to overseas portfolio investments. Uh, Minimum qualification shares and all, these are applicable to individuals if they do so. Now, there is one more structure which comes into consideration, is if what is considered as ODI and what is considered as an OPI structure. Say, for example, if you are investing outside India and if you are holding and control, these are the two main criteria which determines under what structure would you fall, because under each structure, there is going to be different compliances, different eligibilities. Say, for example, if an Indian entity or a resident individual is investing outside India, but he does not have, he holds less than 10%. Guys, if you're holding more than 10%, then that structure is ODI structure, and all the restrictions, compliances relevant to ODI will be applicable. We want to understand what are the scenarios in which you won't have a ODI structure. The calculation is very simple. If you are holding more than 10% or you're having control, if you have any one of this, then it would be considered under ODI structure. But if you are not having control, or you are not having, you are having less than 10%, in that scenario, it will be considered as OPI structure, and the restrictions or liability on you will be lower. Now, these are the few more circumstances in which there can be what could be the condition for ODI and OPI. Specifically, the first one is for financial service sector. Under the financial service sector, you need to have control for the company outside India. Now, beyond, we said that, okay, ye sab to humne kar liya. But what are the other conditions that we need to fulfill? So the other conditions are the pricing guidelines. Whatever you are doing, whether you are acquiring the shares of the foreign entity, or you are already, you are going to be, putting in fresh money into your own company. In both these scenarios, what is very, very important is that the acquisition or the issue of equity capital of the foreign entity is at an arm's length price. Now, arm's length price is not specifically, what it means is that it has to be at a price which is between a known and an aware buyer and a aware seller, and it is at a price at which it has its same normal meaning which it has in other scenarios as well. But it is saying that what is the method to arrive at a arm's length price, that is not prescribed. What it says is you have to do valuation, and under the valuation, there is no specific method prescribed. Whatever is the internationally accepted pricing methodology, you need to consider that methodology and do the valuation of that foreign entity. Who are allowed to do the valuation? Indian chartered accountants are allowed to do the valuation. Indian merchant bankers are allowed to do the valuation. Even foreign CPAs, foreign accountants are allowed to the valuation of that foreign entity. Based on that, we would arrive at the price of the equity share, and based on that price, the shares should be allotted or transferred to the entity is the basic criteria of fulfilling the norms. There has been a common question whenever we deal. We would have like in the last year we would have done more than 30 ODIs with different banks, and a common question. One of most of our clients come back to us and says that Niki, we are putting in money into our own company. You know, it is 100% wholly owned subsidiary of your Indian entity, then why do we need valuation every time we share the money? So yes, the point is right. They say that it is our money only and we are only putting money, our company only and we are only going to be putting money, then why the need of valuation? But guys, the PEMA provisions are very, very clear. Every time you want to put in money in form of equity, you need to do valuation. The way out of this regulation is that you are allowed to invest into equity as into debt as well. Like the Indian entity, whenever they want to invest into equity of the foreign entity, they need to get valuation done. But if they choose to invest into loan, I mean, if they choose to give debt to the foreign entity, in such scenario, you will not require the valuation report. Yes, but at the same time, you would still need to file form ODI and other compliances would still be required. The only compliance that you get saved from is the valuation report. Net worth criteria and everything would remain the same. So if an individual who is investing into a company wherein he has control or he has more than 10% equity, in that case, or is an Indian entity or an Indian individual who is putting in money, in both this case, you will require to file form FC with the company, with the AD bankers. Today also form FC is a physical form that you need to submit with your banker. Once you submit form ODI, which is now called form FC, earlier it was called ODI. Now you submit form FC, you will have you will be obtaining a UIN number. This UIN is a unique identification number, which you get it from RBI. And every time you make further investments or every time you submit your APR, you need to give reference to this UIN. It is similar to a PAN number being allotted to the company. This form FC needs to be signed by your statutory auditor, and the frequency of filing form ODI is only when you are submitting a fresh investment or there is a disinvestment coming into picture or there is a restructuring. Secondly, if you are an individual and you are investing into shares outside India, which can be for a 1% or 2% of a listed entity share, in such scenario, you don't need to file any forms. There is no compliance in such cases. But if you are, reporting of OPI, then there is form OPI which was introduced, and this needs to be reported on half yearly basis. Now, a very important reporting is annual performance report, and there has been a hue and cry around this report. This APR is every individual or every company which has an ODI outside India for which they have filed form FC. And if you own, in an individual owns more than 10%, in such case, they are required to file APR. Prior to 1.5, 2 years earlier, the APR in then APR could have been filed without the audited financials. But now it has become a norm. The RBI has come up with a circular and RBI has amended the provisions, and RBI now says that every company, irrespective of its size, whether it is in profits or into losses, those company need to file APR and get their accounts audited. Now, audit to compulsory kar diya. The second trouble that has started coming up is a lot of bankers had a meeting with RBI because RBI said audit compulsory. The client said, "Madam, हमारी host country में तो audit compulsory नहीं है." So our local auditors, their host country auditors, are not ready to sign because we know how fussy this foreign professionals are. They are saying since they under their law, it is not a compulsion, so we will not sign the financials, we will not do the audit. Now, so it came upon the Indian auditors, because obviously we wanted our clients to be compliant and we wanted their APR to be filed. So Indian auditors started doing a limited purpose audit for the foreign financials and started submitting their APR. This was the scene last year, and then what happened was there was a meeting between the banks and the RBI. In fact, RBI told a lot of banks that please do not accept the audited financials from the Indian auditors. Based on this, a lot of banks, especially PNB and SBI and a couple of other banks, stopped accepting Indian audited financials for the purpose of APR. With this, a lot of companies became non-compliant because their foreign auditors were either not willing to sign or they charged bomb, because their fees used to be in thousands of US dollars to get their stuff audited. Their Indian auditors were not allowed to sign and the bankers did not accept their audit reports. So this was a challenge. We also met RBI officials for the same, and we requested that this was a practical challenge, because of which a lot of compliant companies were becoming non-compliant because they were unable to file their APR on time. And every delay in filing of APR has penalty. So, but as of today, the provisions are still very clear that a lot of banks, a couple of banks are accepting Indian audited financials along with their APR, but a lot of banks are still not accepting, and they are insisting that the audited financials need to be signed by the foreign CPA only. So this is the scenario today. Apart from after filing Form FC, annually filing APR, what other reporting needs to be done is this one reporting, a very, very typical reporting, but gets missed up on most of the times, is within 6 months of the remittance that is done, you need to submit the share certificate with the bank. This small compliance but get missed up a lot of time, because the reporting ke baad it takes time. Once the remittance is made, it generally takes time for the equity share certificate to come in, and by that time usually the professional engaged in the entire stuff is parted. So a lot of times we have seen that this criteria or this requirement remains unfulfilled. So hence very important that you make sure that you receive the share certificate and it is submitted within 6 months. Now, what are the further more requirements is, as I said, get the UIN. We have had one case 3 years back wherein one of our clients wanted to incorporate a company in USA. We did the incorporation. We submitted Form ODI, remittance bhi ho gaya. We did not receive UIN. And within another 15 days, the company wanted to second tranche bhejna tha, because they had their deal with a foreign joint venture. So they had a JV partner who was putting in money, and it was important that the Indian partner also infuse money at the same time. Now, you will not be able to infuse your second tranche unless you have the UIN. So make sure that as soon as you do the ODI, you get that UIN, you get that letter from the banker, which gives you a UIN, and based on that, you can do your second and furthermore compliances. If you have any royalty technical fees to be received, make sure you are receiving it within a reasonable time, which is within 90 days, and the money is received back into India. Form FC ke time, there is always a question, madam, when do we calculate the 400% of the net worth? Guys, I would like you to answer on this first point. Use the chat box and tell me. There is a company whose net worth was 10 lakhs today. They were supposed to remit 40 lakhs. They were capable of remitting 40 lakhs. They remitted, say, example, 30 lakhs. And now their net worth dropped to 2 lakhs by the end of this financial year. What would be the repercussions? Are they non-compliant now, or is it okay? Use the chat box to give me the answer. Let's just use the answer as no, they are still compliant, it's okay, or not okay. Superb. I have so superb audience. Yes, yes. The net worth is as per the last audited balance sheet. Once you have done the remittance, post that, even if the company turns out to negative, even if the net worth gets completely eroded, there is no problem. The company is still compliant. What trouble would be is that next time company wants to make any further remittances, their limits would have been considered to have completely used up, and no further remittances what they would be able to. Reporting of OPI by Indian entity or transfer in form OPI needs to be done every half yearly. As I said, an APR needs to be filed, but if your holding into the company is less than 10%, you do not have the control. In such circumstances, you do not need to file APR. Again, beyond APR, every ODI needs to get FLA also filed, which is by 15th of July every year. Now, what are the rules in case of delay of all this reporting? So if there is a delay in the reporting, then there is late submission fees that needs to be paid. If the reporting delay is beyond 3 years, then LSF, not only LSF will not be suffice, you will have to go in for the older version of what we had of compounding. No remittances you will be allowed, and this is the latest problem. Unless you have all the compliances in place, you have filed even the last APR that was due, till the time you will not be allowed to close or disinvest or do any transaction on this sort. So make sure that your account is up to date. There is a concept which is there is a report which is called as project profile report, PPR. This project profile report is our accounts in the bank's books and which is available with all the bankers. So what I suggest is regularly, if you are dealing with of your clients who has an ODI, make sure you speak to your bank and get that project profile and see all your remittances and compliances that you've been doing are updated in the project profile report. Because if not, we had a case wherein the client wanted to do some transfer transactions, but when we checked their product profile, we realized that उनके earlier transactions report ही नहीं हुए हुए थे. In such cases, bankers does not allow you to do that remittance or do that transaction. Uh, Furthermore, what happened was those transactions was earlier to 2008, and company did not have any proof that they had submitted the form ODI, the erstwhile form ODI, and banker were not ready to accept that we have not updated the PPR. In that scenario, there was no option available to the company, but they had to refile form ODI with all the late fees and compliances and compounding, and then only their project profile got updated, and then only they were able to do the transaction. And hence it is suggested that regularly check your project profile to make sure that all the compliances that you've been doing are updated as well. This was a practical insight because we've been facing this trouble with a lot of clients, especially new clients that come to us. Their PPR is most of the time mismatched. Then there is a late submission fee. As I said, that for regular non-compliances, you have 7,500 as the LSF. And for every delay that continues, you have 7,500 plus 0.25% into the amount and the period for which it continues. But the good part is 100% of the amount involved is the maximum LSF, whereas under compounding, it was 300% of the contravention amount. So LSF in that matter is safer, and the time limit to pay the LSF is 30 days. Now, say for example, you have done the investment, you are through with it. Now, either most of the times what we've been seeing is that a lot of times the company is into losses and now they want to shut, or the company is a disinvestment, which in which case what happens is there is a transfer of the shares. In all of these scenarios, what we need to do is disinvestment. In case of disinvestment, one thing very, very important is you cannot shut the company or you cannot do disinvestment before the first APR is filed, which means minimum 1 year you need to hold the company. RBI बोलता है इतना मेहनत करके कंपनी खोली, 1 साल तो चलाओ, उसके बाद डिसाइड करो अरे ये गलत हो गया और इसको बंद कर दो. They are not ready to understand that, hey, let me cut loose my losses if I have realized it early that it's not gonna work. But RBI says minimum need to continue it for a period of a year, file the first APR, and post that only you can do the disinvestment or shut the company. Second, all the transfers or liquidation or you want to do, you have to make sure whatever your outstanding due is to India is received in India. Second, you need to make sure if you're doing any transfer case, you need to make sure you have the valuation of that foreign entity in place and you're doing the transfer or sale at that valuation ka number at which it is arrived. On that only you're doing the valuation. Second, if you wish to, you realize that there is any merger that is happening. In fact, one of our clients, one of our listed entities, there was no impact here, but their foreign global level there was a restructuring because of which the Indian entity had two more new subsidiaries, new more ODIs coming into picture. There is nowhere in the provision it has been mentioned, but practically we came to know that whenever there is a merger or a demerger, in that scenario also you need to file Form FC and inform to RBI about the transactions. Now, beyond that, say for example, we realize that the company's made losses, as I was mentioning, and that is a case in a lot of the times. The company has made losses, and now you want to write off. So there is a provision under which write off is permitted to a particular extent, beyond which, if you want to write off, you need to take permission from RBI. Now, what are those conditions when you want to say sell off? One, as I said, there should be no write off if you want to transfer. Second, there should be no outstanding due. Minimum, the company should have 1 year into operation. Get your share ka valuation done, and then you can transfer or disinvest. And that disinvestment needs to be reported within 30 days with your auditors. That is where we cover up on all the provisions of FEMA in a nutshell. I'm happy to take up all the questions, and we have kept enough 15 minutes for all your questions. Guys, this is the link to the QR code. We together operate a FEMA and a tax group wherein all of us professionals are a part of it. We exchange our queries and knowledge. So feel free to join the group. But it's a curated group. The moment you'll put in a request for the group, within a day or two, you will get a few questionnaire from the admin. Once you fill in those questionnaire, the admin would let you into the group. So if you guys feel it of value, feel free to join in. I will first take up all the questions that are there on the Q&A. And then I'll also go to the chat box and see to it that we've completed most of the chapters in the chat box. What are the guidelines if there is a write-off? So Aditya, the guidelines to write-off is up to 25% of your investment amount is allowed, but you need to get that value arrived. You need to get your balance sheet and stuff audited. Specific provisions you need to check on the law, but beyond 25, you will not be permitted. For disinvestment, he is asking for a disinvestment when the person holding the company invested, when he was resident Indian, and when he disinvests, he is in US, so NRI. What happens in this case? Do we still need 1 year or we can do it sooner? So here the provision is say there is a UN which is linked to the investment. So till you are going to be cancelling the UN because it is no more an investment from India, it will be considered as an investment from India, and hence all the provisions applicable to ODI will be applied, is my understanding on this case. Next question is, will the recording of the webinar be shared? It is live over YouTube, guys. You will be able to get it. Can a registered partnership firm invest in non-financial sector? Are they considered as regulated in India? A registered partnership firm is allowed, but for financial service sector, you have specific provision. For non-financial service sector, it is permitted because under ODI specifically, the provision is said that yes, registered partnership firm is allowed, and hence it is allowed. NRI, individual working in MNC and got shares of foreign holding company under ESOP. As on date, he sold his all shares which he got in ESOP and remit the funds in India. It is permitted. Now query is, in such transaction, is there any FEMA compliance? There is no FEMA compliance for receiving shares in ESOP and making profit on selling by shares in remitting India. There is no specific provision. You were allowed to hold, you have received the funds back, you will have to pay whatever taxes are, but except for that, there is nothing which stops or there is anything specific under FEMA that needs to be done. As they considered regulated in India, yes, registered partnership firms are. See, the word says registered, non-registered are not. Leasing seems to be under exclusion. Leasing of your own is allowed, but leasing if you're doing as a business, it is not allowed. Individual cannot give loan out of money remitted under LRS. Isn't it like normal debt investment? See, it's Pareen, it is said that you can invest outside India into debt instruments, but you cannot give out loan to individuals. If you want to give out loan into a company, buy the equity of that company and then give loan. My understanding is RBI does not want you to just go out and distribute money, because foreign regulations and foreign currency, foreign exchange is still critical from the India growth perspective. Can unlisted Indian entities make OPI? I have a little doubt on it. I'll come back. Can you again tell the difference between ODI and OPI? ODI is two categories of ODI. One is LRS ODI, where an Indian individual is investing outside India. The other ODI is when an Indian entity is investing outside India. If the Indian entity wants to invest into a company shares which are listed, then it becomes like a portfolio investment, which is overseas portfolio investment, which is OPI. How to determine ALP for a new company? Good question. Methodology is what you can use: cost method, uh, market method, and the income method. Arrive at the valuation, and that can be your arm's length price. Can the transaction be below arm's length price? No, the transaction should be at the arm's length price. Can a resident individual having control in an unlisted foreign company acquire more than 10% stake in such company via ESOP? Ooh, good question. If yes, will be considered as ODI or OPI? Harsh, it's a tricky question. I will have to think through it, because ESOP is permitted, ODI individual is considered separate. But now, since you're breaching the limit of 10%, I'm not so sure. We need to think. For a new company, there would be no valuation right. Here, there will be, if you're subscribing to the memorandum, yes, no valuation required. But even if after a day, even if the company is 1 day old, after the subscription of the memorandum, if you are issuing new shares, in that case, valuation will be required. But a lot of banks are accepting it with a letter, except for a valuation report. If you say, face value is fair value because the company is just incorporated, that is also being accepted practically by a lot of bankers. But the law says valuation will be required even if the company is 1 day old. Subscribing to the memorandum, no, valuation is not required. Here, when you say if Here is saying, when you say if resident individual has more than 10% share, then that company can't have subsidiary. In that case, can husband and wife hold 99.9 in parent company and can have its subsidiary? Yes, here you can. That is a structure which a lot of people are following today. Is valuation required for compulsory convertible debentures? Yes, for all the instruments, it is required. Only for pure debt, it is not required. Question is by Mukul. A resident Indian received a gift from their grandfather in May 21. Is this transaction covered under ODI? If yes, there are any compliance requirements that need to be fulfilled? Yes, if you have received a gift, it is considered. Can an Indian individual resident set up a company outside India and subsequently bring FDI into India by establishing a subsidiary of the foreign company in India? Anonymous attendee, the answer is, if you're an Indian individual, that company which has outside India cannot have a subsidiary, because that is absolutely not permitted. Isliye round tripping will not happen. Round tripping, wherein you Indian entity invests outside India, the outside entity again invests into a foreign, brings FDI into India. This was earlier not permitted at all. Now it is permitted up to 2 layers, but only in case of Indian entity, not in Indian individual. Lokesh says an Indian company wants to do remittance of ESOP of foreign parent company, which is to be acquired by employee of Indian company. Is it allowed? Yes, it is allowed. You will have to comply with the remittance rules of file form 15 CA, and all, but yes, Lokesh, it is allowed. Can an unlisted entity, as I said, I am not very clear on that answer. I'll have to pass it. Can a registered firm? I have already answered this question. What if I want to divest 100% within 3 years? अरे नरेन, nobody stops you. पूरा divest करो, कोई problem नहीं है. Sell it, report, close the UIN. You are done. Our company in UK is struck off. Whether we need to intimate RBI for cancellation of UIN? Yes, Pareen. Within 30 days of striking off of your UK company, you need to inform RBI about your cancellation, which is non-compliance. And LSF will start applying if you miss on the day of 30 days. Guys, I'm going a little fast so that I can cover up all the questions and also finish in the timeline. But I am giving you answers. If you have still any questions and not clarified, feel free to ask. Okay, Jigar has a question. In case of disinvestment through liquidation, say by buyback of shares by foreign company of JV or was, then also valuation report? Yes, Jigar. In all the transactions, valuation report is a must. A resident individual received a gift. Yes, I already said gift ke liye there is ODI, you will require to do it. Any due date for revision of FLA? No, there is no due date mentioned specifically, but you need to revise it what is mentioned. Another question is, are FCRA guidelines applicable for transfer of shares from non-resident to resident? Sir, FCRA guidelines are applicable only in case of donations. This we are not talking about donations. This is pure commercial transactions. Can resident individual incorporate foreign entity? Then that foreign entity takes commercial property on it. Sir, करने मत लगो. ये सारी structuring है. And in this scenario, कुछ structure चलती है, कुछ नहीं. So take specific advice. Incorporated subsidiary in Dubai. Do we need to file Form FC before remittance or post transfer? Before transfer. Before you make the remittance, you need to file Vinay Form FC with the bank. Bank will approve of Form FC. Then and then you will be allowed to make the remittance. Still before that, remittance will not. Purvi Singh, is investment in AIFs considered as ODI or OPI because non-debt instruments include units of API? It will be considered non-debt instruments. A resident individual Indian received 99% shares of a foreign company as gift. Sir, gift we have already answered. AIF we have already answered. UK company strike off, you need to file. You need to file Form FC. Is there a definition of having subsidiary? Subsidiary is the same definition as we had, but from resident individual's perspective, you're not allowed to set up a step-down company only. A resident individual made an investment and set up his own company under using LRS within a year. We have already answered. If you are holding a company and Form OPI file, please file APR, risk mat lo. Okay, we will take up few questions that are pending in the chat box. Indian entity invests in C Corp in US, which then invests in US business. If C Corp then sells its part in US business and is left with cash, how to wind up later? Jay, if you are holding a step-down subsidiary under an Indian entity, you still need to report it under APR of all the step-down subsidiaries that you are having. So, and whatever cash comes to you need to come to the main holding company and you need to bring it back or reinvest. Meeta, can Indian company have more than, let me take up the question from the first so that I don't miss out. I'll take another 2 minutes before we end the session. Siddharth has a question. An Indian company invests in 100% subsidiary in US? Yes. Later, B takes over another US company. What compliances are to be filed? You will have to report it under the APR of the step-down subsidiary investment happening. An Indian citizen incorporates an LLC and does not invest any money. All in place. So make sure, inform your client. You can ask him to file, even remit $1, but get the UIN in place by filing Form FC. Otherwise, it is considered as a non-compliance. For a new company, there is no regulation. Yes, there is no regulation. Uh, Give me a second. I'm just scrolling the chat box to see if there are any questions left out which we haven't taken up. Foreign entity is incorporated in December, and now Indian entity is doing initial remittance. Is LSF applicable? No, it's not applicable. 31st December you incorporated. Now I think you are just 10 days. So no, there is no delay. You need to subscribe. Equity share nahi aa gaye hone chahiye. Put in the money for the equity shares. Get the equity certificate later on. That should be the process. Then there is no LSF that can apply to you. Um, If a resident individual invests in a foreign unlisted company using funds from its US bank account, will it be considered? It is allowed. I think we have covered most of the questions, and we have also tried to finish it in our time. Guys, I hope it was helpful. Try to answer most of the questions. Yet, if there is anything unsolved and you need to have more questions, you can use the group for the questions, or you can also connect to me in person. We'll be happy to help. Um, thank you very much for being a patient. And there was a lot of questions, and I love such interactive sessions. So thank you very much for making it interactive. And I hope it was helpful. Thank you, Senthil. I am happy. I'm glad that it was helpful. Thank you.